Welcome to the Scholars Learning classes. In this video, we'll be studying about the net profit and return on investment. So first, we'll be studying about the net profit. Now, what is net profit? See, it shows you the relationship between the net profit that you have earned over your net revenue from operations. Net revenue from operations, and as I told you, the profitability ratios are in percentage, so into 100. So this is your net profit ratio that you can easily calculate. So let's suppose if you are given, so what is the difference between net profit? What you'll do is, you'll take all the expense, gross profit, you'll subtract all the expenses, and then you'll also add the incomes that have been earned, like income from investment or anything. So if you add all those income back, at the end of the P&L you get the net profit. So this is the exact formula that you have to find out the net profit. So significance of this ratio is, this ratio measures the rate of net profit earned on revenue from operations. So it helps in determining the overall efficiency of the business operations. An increase in the ratio over the previous year shows improvement in the overall efficiency and profitability of the business. So significance tell that higher the ratio, better is the position, more efficient the firm is, right? So this is your net profit ratio. Next comes the return on investment. As the name suggests, that return, what is the percentage of return that you have earned on your investment invested? Let's suppose I give you an example. You have invested rupees 1 lakh in your business. You earn rupees 10,000 out of it. So if I calculate, then your ROI, that is rate of return, would be whatever you have earned over your capital employed into 100. So it gives out you to be 10%. So your return on investment is 10%. So this is very simple how to calculate the return on investment. Means whatever money that you have, whatever funds that you have employed in your company, and on top of that funds, whatever you have earned, that percentage. So with this we come to the formula for return on investment is ROI, also known as rate of return, also known as return on capital employed, also known as yield on capital. So ROI is equal to profit before interest, tax and dividends. If you are given net profits, you will add the interest, tax and dividends from your net profit to earn profit before interest, tax and dividend over capital employed into 100. So I've told you how to calculate the profit before interest, tax and dividend. Either they'll be given that profit before interest, tax and dividend in the question. They might give profit before tax, right? Which means the interest has not been subtracted out of it. They might give the profit before tax, after interest, so you'll add interest into it. So what you basically, your objective would be, you just have to calculate interest, tax and dividend, profit before. So whatever has been deducted from the profit, you will add back those things again. So then the second thing we need to calculate is the capital employed. Now see, there are two approaches to calculate the capital employed. So first approach is your liability side approach. So under this approach, we have the formula shareholders fund, means all of your equity reserves and surplus, shareholders fund plus long term loans, all the long term loans, means your debentures, your loan from bank, minus unamortized expenses. These are the expenses like share issue expense, etc., minus non-current investments, that is the investment that you have made outside the business. So these are the non-current investments. All you will subtract in order to find out the capital employed. Now the second approach is your asset side approach. In your asset side approach, your formula is non-current assets plus your working capital, that is your current assets minus current liability, minus non-current investments. Right? So if working capital is not there, current asset, current liability is given, which means current asset minus current liabilities, you'll find out the working capital, and then you can put it into this formula, that is non-current assets plus your working capital minus non-current investment. So capital employed you can calculate in by using liability side or asset side. Now that depends upon the question, how that question is expecting you to calculate, what are the information. If they have given you the information related to assets, you'll use the second approach of asset side approach. If they've given you the details of liability side, you'll follow that liability side approach. So that totally depends upon the question, how to attempt it and solve. So with this we complete your profitability ratios. We'll be coming up with other videos in which we'll be solving the numericals on the ratios. I hope you like our video. Please download our Scholars Learning app and enjoy the learning experience with us.